It's Brian Resney. It's question and answer day. And one of the big questions that I'm getting is really about the bond market in general. We've had a lot of questions, of course, because interest rates are going up. But what we're finding is a lot of investors really don't understand what's in their portfolio when you're working with these Wall Street firms, these banks, and these insurance companies. What we're finding is an over-concentration to bond investments. And those over-concentration to bond investments, and often the wrong kind of bond investments, are wreaking havoc for this year, 2018, on your investment portfolio. The questions that are coming up is, what should an investor do if they are going to trim exposure in bonds? Where do you put the money? Folks, there's various kinds of bond investments. They don't all act the same, but I will tell you areas you want to avoid. High yield bonds, mistake today. Long-term bonds of any kind, a mistake. Intermediate term bonds, any kind of mistake, whether those are corporate or treasury, it doesn't matter. You want to stay short-term duration. Avoid things like utility stocks, preferred stocks. Things that pay higher dividend are suspect in a rising interest rate environment, and that includes traded REITs. As always, never be sold a non-traded REIT. Only look at traded REITs if appropriate, but in this environment, when rates go up, even traded REITs will do poorly, as we're seeing for 2018. As always, if you are not a client of our firm, and you're concerned about the advice you're getting, and you're realizing it's time you look out for yourself, call Resney Wealth Management for a second opinion consultation. You'll be glad you did. And make sure you listen to my TV and radio shows this weekend.